Hey, welcome back, subscribers, to my world of stocks. So, SEC filings continue pouring in from some of the biggest institutional investors out there. And in today's video, we're going to be covering one of the greatest ever among them in Warren Buffett, who at a whopping 95 years of age is still technically the chairman and CEO of Berkshire Hathaway. And although he is finally retiring at the end of this year from his CEO position, incredibly for his age, he actually still decided to stay on as chairman of the company, which has already been approved by the board too. So it's pretty crazy stuff. He may not be directly in charge of all the executive decisions that affect Berkshire's operations, but as chairman, he will still be leading the board of directors and directly overseeing their long-term strategies, which does involve investments and acquisitions, which is what we care the most about as investors. So pretty cool stuff here. And in today's video, we'll be covering the 5 largest purchases that Berkshire made in their most recent quarter, which just got released to the public like about this past week or so. And I'll run through each one of them for you, sharing my own opinion along the way. I'll even rank them from best to worst too, based on that opinion. So hope you enjoy the video. Let's go ahead and jump straight into it, my friends. And sorted by total size of the position, first up here, we've got the smallest of the bunch in Lamar Advertising, ticker symbol LAMR. A stock that I've actually never covered before on the channel, for which Berkshire had purchased for the first time ever the quarter prior, now increased it slightly by about 3% this latest quarter, bringing the stake up to over $147 million. So basically, when you just take these past 2 quarters alone, Berkshire purchased close to $150 million worth of stock, which is a very substantial amount in just a short period of time. And if you've never heard of this company, well, it may not have the best growth-oriented business, but it does pay one heck of a dividend, which I'll show you in just a second. And that's because Lamar is actually a REIT, a real estate investment trust, with a bit of a legacy advertising business, owning more than 360,000 billboard and other advertising display properties across North America. Now, obviously, that's going to be a bit more antiquated than the higher growth digital advertising that's become more popular, that we've become more used to in the modern age. But that shouldn't trick you into thinking that billboards or even other physical advertising displays have just up and disappeared. Rather, Lamar's business is actually still performing very well, with both sales and profits growing higher in most years, around a mid-single digit percentage, which allows them to in turn also grow their dividend over time too. In fact, ever since converting into a REIT back in 2014, their dividend has more than doubled in size. Now, they do, however, take pretty significant damage whenever the macroeconomy tanks because of their heavy reliance on advertising spending, which caused them to slash their dividend back in 2020. But they do always seem to recover quickly after that, with that dividend, for example, also rising right back up to a record high the year after it was cut, which now pays a very attractive yield of close to 5% today. And the same goes for their stock price, that over time tends to perform relatively well apart from those macro dips. So overall, I just think that Buffett here, being his typical self, probably sees this as a reliable cash cow type of business that Berkshire, would be able to depend on for relatively stable long-term returns, as the need for advertising will, very likely never go away, nor will people having to be out on the road traveling disappear either, where Lamar's billboards can market directly to them. Still, while I do think that this is a solid pickup here by Berkshire, it's I'd say a little too boring of a business and a stock for me personally, but I can certainly understand why a giant like Berkshire Hathaway would choose to park some of their money in them. So overall, probably rank it somewhere in the middle for now at number 3 until we see what else is on this list. Well, speaking of which, coming in at purchase number 2, we actually have a restaurant chain that I just ordered from a couple of days ago myself in the pizza giant Domino's, ticker symbol DPZ, which they increased their position on by double digits in the quarter, 13.2%, bringing their stake up to now about $1.3 billion worth. And when it comes to Domino's business, I'll be honest, as much as I tell myself that I need to stay away from fast food like this, I actually do enjoy some Domino's once in a while. And a big reason why is because the app just is not only very easy to use, but it always seems to have incredible deals. Now, I promise I'm not sponsored by them and I don't even own the stock either, but I do have to give props where it's due. And I think Domino's does a very good job of differentiating themselves in a highly saturated and very competitive market by giving huge discounts online while, in my opinion, still making some pretty high quality pizza for being fast food. I actually like them a lot more than even like Little Caesars or Pizza Hut. Just the other day, for example, I got two large Alfredo pizzas with five different toppings on each one. And it was only like 20 bucks. Both my wife and I ate. I gave some slices to my mom who lives close by, and we still had plenty of leftovers for the next day too. I mean, that's a pretty good value, especially in today's age of high inflation. Anyway, I know I'm ranting a little bit, rambling on, but the reason why I emphasize all of this is because that strategy of actually trying to give their customers some real value is actually working for them. You know, who would have thought to actually care about your customers would have some success? Well, the result is that Domino's not only has the most market share now, but they're also expanding their global presence in a market that is worth around $100 billion. And as such, their sales typically grow by around a mid-single digit rate, while EPS climbs by double digits in most years too. And despite climbing by around 270% over the past decade, the stock price has actually been fairly suppressed more recently these past couple years. Now, you would think that that would leave a cheaper valuation, but it's actually still trading significantly higher than the sector on both PE and PEG metrics, while the dividend is still pretty small at just less than 2%. So even though I may love their business execution, the actual stock itself is just not as attractive of an investment as Lamar Advertising, who will keep that number 3 ranking from me, while Domino's gets placed just under them at number 4. All right, guys, coming in at purchase number 3, though, we have what has been an extremely volatile and very poor performing stock, which is a little unusual for Buffett to still like them so much despite the struggling business. But that is in Sirius XM, ticker symbol SIRI, at more than a 5 million share increase during the quarter, bringing their stake up to now nearly $3 billion, with it also being the first stock of the list to also be worth more than 1% of the entire portfolio. Now, like I said, though, the company has actually been really going through a tough time in recent years. And although it has seen small periods of success where the stock would rebound, at least temporarily, by sizable amounts at times, it's ultimately still lost more than half of its entire value over the past decade, to where it now sits near the lowest levels of that range, having also lost over 70% from the top. So just an absolutely massive crash here that we're talking about, to which Buffett seems to be exercising that old mantra of his to be greedy when others are fearful, as he continues to buy the dip on a valuation that, granted, is now around 50% lower than the sector median, while the dividend, and mind you, this is a tech company that we're talking about here, the dividend has now risen all the way up to more than a 5% yield, with still some excellent growth metrics to go along with it too. Now, obviously, all of that alone would normally make this a very attractive, tech kind of oriented type of stock to consider, if it also had a stable enough business to rely on for a long-term recovery. But unfortunately, I'm just not convinced that that's exactly what we have here, as the business is primarily reliant on satellite radio, which I just feel is a bit of a sinking ship in the wake of online streaming. Now, don't get me wrong, being the number one leader in satellite specifically is something to be proud of, and the later acquisition of Pandora was supposed to add a little more diversity and exposure into online streaming for them. But I just don't think it can ultimately compete long term with the likes of not just Spotify, but also Apple Music, YouTube Music, and even Amazon Music, all of which not only have many millions of more subscribers, but they also have the financial backing of some of the absolute largest tech giants in the entire world. By the way, did I mention Spotify? Anyway, yeah, I think I mentioned them. Anyway, those are some giant companies to be competing with. And it's just going to make it even more difficult for them, I feel, to have a recovery longer term. And in turn, it's also causing just multiple years now that we're seeing of both revenue and profit declines. I'm not necessarily saying that this is a value trap, but I wouldn't be all that surprised if it does turn out to be one. they could turn things around. I've certainly seen stranger things happen in the market, and having the backing of an all time great like Warren Buffett does definitely bode very well for them. But it's not a bet that I'd feel very confident in myself. And for that reason, I'll still be staying on the sidelines with this one while giving it the last place ranking on the list too. So I just have a bit stronger faith, I'd say, in the other businesses that we've seen so far. All right, guys, we're now down though to the final two purchases, which are the two largest holdings of the bunch. And coming in at number four, well, we actually have a brand new pickup from Warren Buffett, new one in the quarter. That was in Google, ticker symbol GOOGL, which Berkshire went pretty ham on, actually buying over $4.3 billion worth just in the quarter alone. We'll keep this one very short because you guys know that I do talk about Google all the time. It is, of course, a substantial holding in my portfolio. It's a stock that I've liked for a long time now. And really, the reason why is because I just love their incredible size, their dominance, and the still high growth that they experienced despite that. In fact, last year alone, they did over 350 billion in sales on almost 14% growth, with over 100 billion of that going straight to the bottom line in pure net income profit, which was a whopping 35% growth year over year too. It's practically impossible to find another company doing those type of numbers. And it's all due to their incredible apps and platforms that command the most market share out there, resulting in huge amounts of advertising revenue. And yet I still think that this incredible growth will continue for one giant reason. And that's the rise of AI, for which nobody will have more data at their disposal, what I think will actually be like the new oil or gold of the 21st century, than Google, who practically knows everything about you because they own Search, Android, YouTube, Chrome, Gmail, Maps, Gemini, and more. The only issue with Google stock right now that I can think of, I mean, it's a phenomenal company and stock. The only issue is just the price alone, which after breaking new record highs is leaving the valuation around 30% more expensive than the sector on a PEG basis. But even then, wouldn't you put at least a 30% premium on a company like this? I know I would. Sure, it'd be great to grab it a little cheaper. And, I've certainly been sounding the alarm many times at you guys, as you know, in previous videos, when that PEG ratio was actually lower than the sector. But I'm not going to fault Buffett for being a little late to the party now and still buying some, because I actually think everyone should own at least a piece of this stock in their portfolio, for which you can always just add some more on any future dips whenever they come anyway. But either way, it's taking the number one ranking for its sheer size, dominance, and growth on this list. All right, guys, with that said, we're now left with the fifth and final purchase. This is the largest holding of the five, and it was in a stock that doesn't get brought up too often, but that is Chubb Limited, ticker symbol CB, which they increased their position on by another double-digit percent, bringing the stake up to now $8.8 billion worth, and it's worth over 3.3% of the portfolio. Now, when it comes to Chubb, though, it's for sure a very typical Buffett type of stock. So picking up a few more million shares here before his CEO retirement does make perfect sense, as this is one of the largest insurance companies in the world. In fact, they're actually the largest publicly traded one, with operations in over 50 different countries. Now, they're also pretty well diversified, as much as you can be really for an insurance company. That's across commercial and personal property, casualty, accident, health insurance, reinsurance, and even life insurance too. Of course, we know that Buffett has always been drawn to these type of large insurance companies for their relatively stable financials and strong cash flows, with Chubb being no exception, doing a record more than 55 billion in sales, which is up double digits, also more than 9 billion of pure net income profit just in the past year alone. And that strong performance is also helping them pay a nice little dividend that, although it's very small at just around 1.3%, it does at least have a ton of room for growth given the tiny payout ratio of only 16%, with nearly 3 decades of consecutive growth to go along with it. As good as some of these numbers might seem, though, the stock is already breaking new record highs, and it seems that analysts expect a big slowdown in growth because their PEG ratio is also very high at over 2.7 for an insurance financial type of company, and that's 160% higher than the sector. So considering the tiny dividend yield, the expected slowdown, and the high valuation for what is actually a bit of a slow moving stock, I just don't really know where I would get some big returns from this one. It doesn't have any kind of revolutionary business. There's no giant rebound potential in the stock price. The valuation is already high. And like I said, as good as the dividend is on growth metrics, the yield is so tiny that it would take way too long to even get it to a meaningfully higher level in the long-term future anyway. So I think this is totally fine for a giant like Berkshire Hathaway that just needs a safe place again to park their money and generate reliable returns. But for someone like me who's not yet rich, I need bigger potential from my investments. So it's gonna go, I don't even know. I mean, other than Google, I feel like the rest of these could probably be ranked in almost any order, but I guess I'll bump Lamar up one spot to put Chubb in its place at number 3. And that does look kind of good to me there, I think. Now, like I said, Google is by far the only stock on this list that really attracts me. And even then, it's a little expensive at the moment. Not saying that any of these other stocks are bad, but they're just a typical type of Buffett stocks that most of us would probably not find too interesting ourselves. Lamar does look good, though, I gotta admit, don't get me wrong. And I haven't really done too much research on them, but just from what I've seen already, they do seem pretty strong. If I was going to buy a typical type of Buffett stock, I'd probably go with them over these others. But hey, I'd love to hear your thoughts down below. Do you agree with my rankings here and anything I said? Would you like to add to the conversation? Let me know down in the comment section. Hey, if you'd like to support my channel, you can always hit the like button, you can subscribe, or you can go above and beyond, support me on Patreon. Link is in the description. Really means the world to me if you do that, and you get access to our Discord. You get commercial and early access, commercial free and early access to our videos, which is also fun too. So yeah, there's some cool perks there if you want to check it out. But either way, thank you just for stopping by. Really means the world to me. I hope you're all doing well, my friends. And I will catch you in the next video. All right, take care, everybody. Bye-bye.